We got another amazing video from Pinhead Paul Gabriel. Welcome back to Strongman Personal Finance. So now Paul, the stock picker, and also the shorter of massive tech stocks that go up a lot, who lost millions of dollars for his family, and who has massively underperformed every single index known to human history, is now telling us the 3 ETFs he would never sell. So now Mr. Pauly Boy here is transitioning over to ETFs. And of course, by doing so, he shows his insane ignorance. Not only is he a bad stock picker, which is the whole point of his channel, he's also a clown when it comes to picking ETFs. And I'm going to show you with data why his logic is completely flawed and he's an incompetent clown. So let's go ahead and see what he has to say. We're going to speed this up just a little bit because I can't listen to this freaking clown that long.
There are 3 ETFs that I'm never going to sell ever. And I'm going to share with you why you should never sell these, because they can help you secure your financial future in retirement. My goal in life is to live off of my brokerage account. So when I put money into these things, I want to make sure that it generates me enough income where I can live the life I want to live and keep reinvesting in the future. For you, your job, if you're saving for retirement, is to make sure that your money goes into tax-efficient accounts that can grow and compound for decades to come. So that
Okay, I agree with that. You should put your money in tax-advantaged accounts, like an IRA or 401k, HSA, etc. And you should let that grow over your life. Dollar cost average, 100% agree. But he's preaching to you as if he's above you, because his goal is to live off of his brokerage account. He's already ascended from the lower stages of poverty that we're all at. He's now above us and is going to teach us how to build wealth. He thinks he's better than you. He's a doofus, as you're going to see.
That way, when you're ready to retire, you have all the money you need. Now, even though our situations are different, our goals are the same. We want to be able to have enough to live the rest of our life and not worry about things. And that's why these 3 ETFs will be added to my portfolio. These 3 ETFs are SCHD, SPY, and QQQ. So what are they? SCHD is the Schwab dividend portfolio, which tries to mimic the Dow Jones 100 dividend portfolio. SPY, S&P 500. Very simple. And if you only do this one, you're probably going to do very well in life.
Okay, let's pump the brakes here. So we got 3 ETFs. We have SHDA, which is basically, think of it as a high dividend ETF. Pays a lot of dividends, and it's gone up a decent amount in the last 10 years. United States. SPY is the S&P 500. That's the top 500, 508 companies in America. Roughly 80% of the market capitalization of the U.S. market. And then QQQ, which is the top 100 non-financial stocks listed on the NASDAQ. So we got 3 ETFs here, right? Do you realize that basically all the constituents of SHDA are going to be in SPY? And all the constituents of QQQ, my sand shrew, are going to be in SPY as well? That's interesting. Why are we having this overlap, Paul? Teach me.
But if you want to get some extra returns, I think you got to add QQQ into your portfolio. This is the NASDAQ 100, which is highly concentrated in high growth, high compounding companies like Adobe, Microsoft, NVIDIA, and that takes the guesswork out of what companies to pick that can grow for the future. Now, you guys know me.
Okay, that's a common retail low IQ assumption, is that certain ETFs give you extra juice. You just buy an ETF and it magically just goes up and it outperforms because it does, because that's what it did in the past. That is wrong. Okay? There's no magic button to buy. There's no magic ETF that outperforms. And if this was a magic ETF that outperformed, if you think you can outperform by buying QQQ or putting it as a part of your portfolio, why not just go all in? Serious question.
I have 18 individual companies and I want to have 30 or 40, but it's not mutually exclusive. I'm still going to add these to my portfolio along the way. Why? Because these do a good job of hedging myself and smoothing out my returns. So if some of my stocks are laggards for a while and these things are up a lot, boom. If some of my stocks are doing well because they're more value plays while these are down, boom.
Okay, I guarantee you, most of the individual stocks that he's buying are also in the SPY. So he's got the SPY. He's got individual stocks that are in the SPY. He's got big tech, basically, QQQ, that's in the SPY. And he's got SHDA. That's also in the SPY. Is there a way, if you were to pick one of these 3 ETFs, is there a way we could potentially simplify this? Sit down and think about it. If all of the stocks are in one ETF, Why do we need 3 ETFs and then also buy 18 more stocks? It's almost like you're making your portfolio complicated because you just want to.
Hedging myself in a certain element. Now you might think, well, that's over diversification. Maybe, but my position in life actually is very similar to yours because I want to live the rest of my life with my money, and you don't need to touch that money until you're 65, and then at that point, you'll live the rest of your life off that money. But
okay, you're not in the same position as him. He is a spoiled rich kid that is living off daddy's money. He's ahead in life. He has more money than you, more money than me because of his daddy. You don't. You cannot afford to play games like this. And now he's saying over diversification. This is not over diversification. This is over complication. There's a reason I have 1 ETF in my portfolio. And you may laugh, but trust me, it's way better than this freaking portfolio, which is just a bunch of complexity simply to create the illusion that you're actively picking when you're just buying the same stocks under the different wrappers of different ETFs. And some of these ETFs have higher expense ratios. And of course, he picks the SPY, which out of all the S&P 500 ETFs has one of the highest expense ratios because, I don't know, he wants to pay more money.
But the goal for you is to make sure you're putting it in tax-efficient accounts like your IRAs and your 401ks so it can compound and compound and compound for decades to come. So let's break down these ETFs to see what's in them and why they're attractive to me. So this is SCHD. Again,
why are they attracted to you? Or I don't think they're attracted to you. I don't think anybody's attracted to you, including the spouse you have that's using you.
This is the Schwab dividend portfolio. Expense ratio. Look how low that is, 0.06. That means, let's break down the math. If you put $1,000 into this, 1% would be 10 bucks. 1% of 1% would be 10 cents. So this is 60 cents a year for every $1,000 you put in there. That's nothing. The average mutual fund charges around 1%, if not more. So this is going to compound on you for a long period of time. Next thing, people love dividends. 3.39% current dividend yield. And I argue the market's massively overpriced. So when the market falls, this dividend yield is going to go higher and higher and higher. All right?
Oh my God. Let's think about that statement. So the dividend yield is calculated by taking the, let's say, a price of a stock and dividing it over the last year of dividends paid. So what he said is, if the stock price goes down, or sorry, it's the dividends divided by the stock price, then the yield goes up. Well, of course the yield goes up because the stock price is dropping. Look at Walgreens. Walgreens is down massively, and it has a crazy dividend yield because the stock itself has massively sold off. Just because it's not good that your dividend yield is growing in a scenario like that because the stock itself, the company itself, is deteriorating. It doesn't make any sense. What a freaking airhead.
Turnover ratio, 28%. That means they keep their stocks on average about 4 years. Not bad. Total assets under management, this is a good size fund. $64 billion. A lot of money in here, a lot of net inflows right now. And my guess is, as stocks fall, these are more reasonably priced stocks, giving a good dividend. My guess is this will not suffer the same outflows that QQQ or SPY might get. So it's a great place to get some dividend if that's what you want. And you can, in your tax-deferred accounts, this can grow your dividends and compound on itself and reinvest it at higher rates of return. Here are the top 20.
No, that's not how that works. It drops by the amount of the dividend, and you can take that money and buy more shares. But it's not extra compounding because you're getting dividends. It's money going from one piggy bank to another, and you pay tax on it if it's outside of a tax-advantaged account. But it's not extra compounding. What's compounding is the earnings of the company, which allows a company to pay higher dividends in the future. Duh!
25 holdings for SCHD. Home Depot, BlackRock, Cisco, Chevron, Lockheed Martin, Bristol Myers, Verizon, Pfizer, Tech. The point is, it's all...
Yeah, none of those are in the SPY, I would imagine.
Companies you know. I would be surprised if any of these were gone in the next 10 years. So these are high-quality businesses. Now, I'm not breaking down their balance sheets. I'm not breaking down their price to free cash flow. The point of an ETF is you dollar cost average. Markets are up, markets are down. It doesn't matter. You keep reinvesting. ETF number 2, SPY, follows the S&P 500. Very simply. Higher expense ratio, which surprises me, than SCHD. Lower dividend yield, which makes sense, especially in this recent market where the Magnificent Seven that don't pay much in dividends, if at all.
But Paul, if it crashes, the dividend yield will go up.
All are surging. Turnover ratio, 2%. That means once every 50 years, the thing turns over completely. 592 billion in assets under management, adding 40 billion. Now, guys, there's another S&P 500 ETF called VOO, VOO with Vanguard. The difference is expense ratio is 0.03. Now, it's lower, and I will believe in that. But again, every $1,000, we're talking about 60 cents difference.
Okay, but at his level of wealth, you're actually paying thousands and thousands more. It matters. The richer you get, the more expense ratios matter.
It adds up. But again, for some reason, I'm just committed to SPY because I owned it in the past and I've always owned it. But Vanguard is a phenomenal company and I probably should switch to that. Now, guys, here are the top 25 holdings for SPY. And they're going to go in order of market cap. Apple, Nvidia, Microsoft, Amazon, Meta, Google, Broadcom, Berkshire, another Google. These are the same company. Don't worry about that. Eli Lilly. Guys, the bottom line is these are companies that are great. These are large companies. They're going to drive the markets. These are the top 25 holdings and they probably make up 40 or 50% of the market value, if not more, of the S&P 500.
But almost none of them are in Shada.
These are ginormous businesses. Your goal, your benchmark, everyone's benchmark is SPY. So if you're always investing in SPY.
No, it ain't. Especially if you're heading towards retirement, your benchmark is not always going to be the SPY. Okay, if you're retired, you're not going to outperform the SPY most likely because your portfolio is more suited to a retirement-oriented portfolio. So no, you're not always competing against the SPY. That's ridiculous.
Always investing in that CHD. How do you beat the market? Well, here's how you do it. You add QQQ to it, but you got to add it at the right time. Now here's Q.
Oh my God. So he says dollar cost average in the tax advantage account. And then he says you got to buy QQQ at the right time. That is not dollar cost averaging. That is timing. That goes against what he's saying. Oh, let's look at the expense ratio.
QQQ stats. Higher expense ratio, 0.2%. Dividend yield, nothing, 0.6%. Turnover ratio, 22%, similar to SCHD, and 300 billion in assets under management and inflows of 22 billion, which I think are a lot based on where the markets are.
Okay, so Shada more dividend focused, QQQ less dividend focused. It's almost like the SPY is somewhere in the middle because it has all of them. Crazy.
The high tech companies. This is going to look very similar to SPY at the top. Apple, Nvidia, Microsoft, Broadcom, Meta, Amazon, Tesla, Costco.
Exactly. What a massive pinhead clown. Let's compare the top holdings of SPY to QQQ. QQQ is Apple at 8.9. SPY is Apple at 7.2. QQQ is Nvidia at 8.4. SPY has Nvidia at 6.5. And you go down and down the frickin' list, okay? It's the same companies. So why are we buying this? I don't understand what you're doing. Oh, that's right. You're an incompetent clown pinhead.
You might look at it going, Costco. Yeah, Costco, it fits its criteria. AMD, Netflix, Google, PepsiCo. There are some companies here that pay nice dividends. This is all about the NASDAQ 100. And some companies are in the NASDAQ, but aren't necessarily high tech. But most high tech companies are in the NASDAQ. And the reason QQQ can do so well, tech companies are able to generate much higher returns on capital than other companies. They don't have to invest as much to get high growth returns. You look at a company like Google, not much growth in there, but they can grow their earnings per share by big leaps and bounds, double digits per year, because of their ability.
That's not priced in.
To generate more and more returns on less and less money. That's how you generate a lot of wealth quickly. That's how you get the multi-baggers.
Just buy QQQ and you'll just get your wealth will go up a lot. It's just easy, bro. Forever into the future. There's also risk with high flyers. That's right.
So, as I was saying, let me compare QQQ and SPY to show how you can outperform the market by buying QQQ at the right time. So this is how you can use QQQ to beat the market. Guys, this is a chart of QQQ's total return versus the S&P 500 from June 1st of 2003, which was basically the low after the markets had crashed for 3 straight years. Now, obviously, this is the low, and it's a massive beat. Now, remember,
just buy the low, guys. Just buy the low. It's easy.
After COVID, big drops, and there's a huge surge in these tech companies. But again, even going back, they outperformed. Now, let's check how they did from the peak of the 2000 bubble, because there's a lot of interesting data here I really want you to see. This is essentially from the peak of 2000, March 31st of 2000. I think the peak was like March 20th or March 10th. Here's QQQ, here's the S&P 500. Again, the peak. But remember, look how much it fell. The NASDAQ fell 83% from its peak. The S&P fell about 50%. Big time difference. And it took a
Yeah. High flyers, sometimes, high beta stocks have more downside if the market goes down.
a long time. It took a long time. It got close to even at COVID. But guys, this is huge. Now, You might look at this and go, well, Paul, I can't time the market. And it goes to show that I shouldn't be
Exactly, Paul, because you're a freaking pinhead.
investing now because valuations are so high. Well, wait a second. What we discuss all the time is dollar cost averaging. Let me tell you this. I went back personally and I did the numbers from the peak of the 2000 bubble. So let's say you started investing literally at the absolute highest point and you absorbed that 83% fall. If you dollar cost averaged $200 per month in the S&P and QQQ, today, you know what your returns would be? Let me show you. Your QQQ return would be 13.5% annualized, while your S&P 500 would be 10.5%. And this is after watching an 80%.
You won't, dollar. You will sell. I know you all. You will sell. Trust me.
Fall. That's the power of dollar cost averaging and letting things come.
Exactly, pinhead numbnuts. And on top of that, guess what? I can't even freaking react to this anymore. This is such a stupid video. He's overcomplicating his entire freaking portfolio. He's showing you past performance as an indication of future performance. Look how much his portfolio has churned in the last 4 years. His portfolio has changed radically in the last 4 years. And yet he thinks you're going to DCA when something crashes 83%, which, oh, by the way, happened in the past. That was in 2000, 2001, whatever. What year is it now? It's 2024. What happened in the past doesn't mean F all. Get this through your freaking heads, okay? If it was this easy, we'd all be trillionaires going all in NVIDIA because it went up a lot. It's not that easy.
Compound. So you'd look so bad along the way. But as stocks fell, you'd be adding more and more money. And as they started to gain momentum, all that money that you added would keep growing and growing and growing. And look at this massive outperformance. So this is why I believe that you can beat the market using just ETFs. Basically just using 2 different ETFs, SPY and QQQ.
Then why are we doing Shada? I don't understand. If we can beat the market, why are we even bothering with Shada?
And this is exactly why I'm going to include those as my 3 ETFs that I never want to sell. Now, the last one, SCHD, I've made a video before, and I want to explain to you why I like SCHD. 1,
because it's popular on YouTube.
Less volatility. It tends to do better during bad times. Why? It's a dividend ETF. Tends to be more boring companies with less volatility, less hype. So when things fall, they're going to go down a lot less. When things are up, they're going to go up a lot less. Here's proof. From the start of SCHD back in 2011, it's the worst performer. QQQ is up 891%, S&P 500, 518, SCHD 415. But look, SCHD and SPY only started to shift apart really substantially back during this Mag 7 huge monster rally.
I hate investing so much. I really do. God bless America.
Apart from that, they were pretty much in lockstep along the way. So it's a good way to get some dividends, less volatility, and grow your money. Now you got to keep in mind, my situation is different. If you watched our video about SCHD, I told everybody, guys, the reason SCHD works for me is I have 1,000 apartments upstairs and growing. We're going to have...
You have 1,000 apartments upstairs? What are you, in the Eiffel Tower?
Have 5,000 or 10,000 units in the next 10 years. I've got 5 or 6 businesses upstairs, 2 or 3 of them which generate big revenue and good profit. Okay? I don't need my money to kill it for me, so I'm okay getting less returns.
Or you could just buy the market, pinhead. If you're that busy with your business, that's more of a reason to buy a total market index. If you're that busy making money, put it in the freaking whatever you want, SPY or VT, whatever. Why are you picking stocks if you're that busy? It makes no sense.
I'm okay being a little more conservative. And don't forget, I'm still buying
conservative. I'm conservative.
Buying stocks, individual companies that fall into my category that I really want to own at great prices. I can be pickier on my investments in individual companies as I have these ETFs in my portfolio. Now, in full disclosure,
no, you can be an absolute clown and blow your money over and over again. That's what it means.
I don't own any of these ETFs yet. I'm trying to decide how I start dollar cost averaging, because that is my plan. I will dollar cost average in all 3 of these ETFs at a certain point.
I thought SCHD was 25% of your portfolio, Paul. Didn't you make a video saying SCHD was going to be 25% of your portfolio? Now you don't own it? What's going on here?
And just start going month to month. History has shown that putting the lump sum in tends to do better. But for my psychology and the fact that I can still get 4.5% of my cash, I'm in no rush. So for me, I'm going to dollar cost average into these. And if stocks fall, there might be some individual companies I want to keep adding to. And that'll do really well for me over time. And on top of that, all 3 of these ETFs have a lot of volume and they're big. So I can sit there and generate extra income on my money by selling covered calls and cash secured puts.
Oh my God, now he's doing covered calls, which limits your upside. What is he doing? What a pinhead.
In order to buy and to generate income along the way. That income can generate 1% to 3% extra per year. And a lot of our community members are doing way better than 1% to 3%. In fact, Mo and I tend to do a lot better than 1% to 3% since we've been doing this for the last 4 years.
Bull crap, lying scumbag scoundrel. This is the worst, one of the worst videos. They get worse and worse every year. They have deteriorated massively. What are they going to be shilling next year? Levered ETFs? Like, what do y'all think? Let me know in the comments below. Like the video. Check out the pinned comment if you want a sponsored video, or you want to buy my book, or you want to meet me one-on-one. And you guys have a wonderful, delicious day. Cheers!